Thank you, everyone, and welcome to this week's speaker series. I'm happy to be joined today by Gary Rozier. Gary joins us from Blue Owl. Gary, glad to have you with us. How are you today?
Great. I appreciate having the opportunity to be with you.
Great. So let's talk a little bit about your firm, Gary, and your position to sort of introduce you to the network. This is a relatively new product on our platform. It's coming through our iCapital offering. It's just one of our sort of couture products here on the private side. Give us a little bit of background on Blue Owl and Oak Street Net Lease Trust more generally.
Yeah, happy to do that. And again, I appreciate having the opportunity to speak with you. Gary Rozier, for those that I haven't met, serve as managing director at what is now Blue Owl Real Estate. So I come from the legacy Oak Street Real Estate Capital business, which is a net lease real estate investment firm founded in 2009 in Chicago. We've raised closed-end funds since that time. This is our first non-traded REIT, Oak Trust, that we're offering, really built for the private wealth investor specifically. We manage inside the Oak Street business a little north of 20 billion of AUM. Again, everything we do is triple net. So we are very specific. We have a niche. That's where we play. We don't do anything outside of that. Our parent company is Blue Owl Capital. Blue Owl Capital acquired Oak Street in late 2021. And Blue Owl is a diversified alts manager. We have three divisions, ours, of course, being the real estate. We also have the legacy Dial Capital business, which is a GP stakes business. It's a company that takes revenue streams of alternative managers. And our third, which is really the kind of the core of the business, is our legacy Owl Rock business. And Owl Rock is our direct lending platform. So the three make up parent company Blue Owl.
Okay, so let's focus in here on the triple net lease product, which is the one that you're affiliated with and the one that you manage. For our uptake on the alternative side is growing, but it historically has not been a significant portion of our business, but it is becoming more so and so over time. So maybe give us a quick introduction into what exactly is a triple net lease, and how is it potentially a good gateway for people who are more used to, let's say, public REITs and other sort of public real estate investments to potentially dive into the private markets?
Yeah, happy to walk you through it. I actually start all conversations just describing what a triple net lease is. I think a lot of investors have probably heard it. They know what it means, but some don't. The simplest way to put it, when we buy a piece of real estate and lease it back to a tenant, we structure our agreement or our lease, our contract, in a way that the tenant is responsible for all the operating expenses of owning that asset, right? So we actually own the building, but our tenant manages it and runs it. They operate it, but they're also responsible for all the operating expenses. That's taxes, maintenance, insurance, capital expenditures, utilities. Think about all the things that you have to pay for inside a piece of real estate. Well, that is all the responsibility of the tenant, not us as the asset owner. We love that structure for a number of reasons. One is it really takes the variability of real estate out of the equation, right? You live in certain jurisdictions. You're in Florida. Your insurance costs go up year to year. I live in the city of Chicago. My taxes go up every single year, right? The cost of your utilities go up with inflation, the cost of your raw materials, et cetera. Nice thing is, as the asset owner in a triple net lease structure, none of that is my responsibility. The tenant has to pay for all of those things. So we like it because it gives us, again, variability taken out, but also gives you clarity of what your income is going to be, because your income is not going to change. Again, all those things that change year to year, that's a tenant's responsibility. So everything we do is going to have that triple net lease structure, right? So every deal within Oak Trust will have that triple net lease structure. So us as the asset owner or you as the investor will not be exposed to any of the operating expenses of the asset.
So, but at the same time, that adds a sort of another layer of due diligence from your end, because not only do you have to be comfortable with the underlying real estate and the dynamics behind it, but you also have to know the tenant, their business, whether they're profitable, their staying power, those kinds of things. So explain to us and to our audience exactly how do you start making about these investment decisions?
So interestingly, this is going to sound a bit odd because we are real estate investors, we actually don't start with the real estate. We start with the credit. And you said it. We want to make sure that the viability of the tenant inside the building is strong. It's a high cash flowing business. It's a strong balance sheet business. It has the ability to weather storms. So we actually start with credit. And what I mean by that is, I don't care how great the building is. If I don't like the credit of the tenant inside, I'm not doing that transaction. You can show me the Taj Mahal and I will not buy it if I don't like the tenant credit inside the building. And the reason for that is our strategy is really about buying an income stream that is just backed by the hard asset, right? So we underwrite in two silos. We underwrite the credit first, make sure again that we like the viability of that business long-term. Then we underwrite the hard asset, because if we're wrong about the credit, you want to make sure that you still own a great physical asset that you can either re-tenant or you can sell later. So for us, it's really a two-prong underwriting, but we start with the credit.
Okay, so would you say that the assets here under the strategy, what's the correlation with typical real estate assets that other investors might be more familiar with? Let's say with, public REITs, like, actually, let's go to your fund specifically. So see that you're roughly, you have roughly 57% or so in industrials, about 20% or so in essential retails, slightly under 10% in land, some 6% in office. What are are the correlations typically what they would find in, let's say, an industrial? How does that match or compare?
I mean, I love the question because it's the first thing I'll say to answer it, just to get cut right to the chase, is we tend to be completely uncorrelated, right? Even with the broader real estate market, we're just not correlated, because again, our strategy is much more about the income coming out of the asset, not so much about how the hard asset trades. Now, the value of the hard asset matters, don't get me wrong, right? We have an NAV that we strike every single month. And one of the considerations is the value of the asset and how it trades in the open market. But what's more important is the income stream, right? Is it paying income every single month, right? So again, we tend to be uncorrelated. When I write our quarterly letter each quarter, one of the things that I always do is show what is the performance of the privately traded REIT world, the publicly traded REIT world, and then our portfolio. And it's almost never correlated. Again, because it's less about the hard asset and more about the underwriting and income of the tenant. So it's very diversifying to your traditional real estate.
Okay. And so let's focus specifically here on the Net Lease Trust. I sort of gave the broad breakdown of the by property type. Is this typical for the trust to have this type of breakdown? Do you deviate from this substantially? Do you go where you see opportunities? Does it matter, the strength of the tenants in this space, right? Let's dive a little bit into that. Why do you have the current breakdown by property type that you have today?
Yeah, the current breakdown is what you should come to expect from us. When it comes to sector allocation, I'll start by saying we are bottom up and driven by the opportunity, not top down, right? So we don't go into a fund, any of the funds, right? Oak Trust or any, and say, we have an expectation that we'll be X% in this sector, X% in that sector. We really want to, like I said, start with the tenant first. We want to start with the credit, making sure that our counterparty is good. And then from there, we want to go to where it's most likely for us to be able to do a transaction with that tenant at pricing we like. It just so happens that our portfolio is and should be over time, the expectation, majority industrial and essential retail, right? That's going to be 70 to 85% of the portfolio at any given point in time, right? We will be much less allocated to office. Okay, I think again, today we're less than 7% in office. And if you look at our historical allocation to office going back 13 years, we're always under allocated to office. This is not like a post-COVID thing. It's not new to us. And the idea is we want mission criticality in everything we buy. Okay, and it's just harder to identify mission critical assets in office.
Explain that a little bit more. Yeah, flesh that out. Yeah.
Yep, I was going to dive into it because we're pretty specific about what we mean by mission critical. The short answer is we want an asset that is extremely important to the operation of your business. Let me give you an example. In industrial, we like to own distribution centers, specialty manufacturing facilities, or logistics. Okay, and I'll give you a live example. We did a transaction with a company a couple years back called Big Lots. Big Lots is like a small Walmart, Ohio-based discount retailer, great organization. At the time, they owned 5 distribution centers around the country. Okay, they had a need for capital. We provided it by buying 4 of their 5 distribution centers. At the time, our 4 buildings were moving or housing 85% of their commerce. That's mission critical, right? Meaning like they're going to pay us rent before they pay anybody else because, well, we have 85% of the commerce coming through our buildings. That's mission critical. Let me give you another example. In retail, which again, we like retail, but we think retail is pretty bifurcated. Okay, there's retail we want to be in, and there's retails we want to be clear from. The retail that we like and where we'll invest, very defensive, non-cyclical, low ticket, non-discretionary items. I know that was a mouthful. What does that mean? Toothpaste, toilet paper, right? So we love groceries, discount retailers, pharmacies. Again, these are things, it doesn't matter where we are in a market cycle. You and I have to buy these products. What we don't want is quite the opposite. Deep cyclical companies, Tiffany Diamonds, John Deere tractors, great businesses. But our point of view is like, if you get into a tough part in the market, you can put off buying a $150,000 tractor or a $50,000 Tiffany Diamond. We want those low ticket, non-discretionary. That's why we like those 2 sectors, because they tend to be very mission critical, non-cyclical. And why is that important? It's important because we expect those buildings to be occupied at all times. And we expect those companies to be paying us rent, right? So we don't have to get worried when we get in different parts of the market cycle. Those companies should be able to make money all the way through, right? That's what we mean by mission critical. Last one I'll give you, because you asked, and this is very important. If we do office, what we define as mission critical in office, headquarters or regional headquarters, right? It's hard for you to exit those types of assets, right? A suburban campus where you can send everybody to work from home, a little bit easier. But when you have your highest level of human capital in that building, like CEOs don't work from home, treasurers don't work from home. If we do it, it's going to be very opportunistic, mission critical still in office, but headquarters or regional headquarters, you should expect that to be the smallest part of our portfolio.
Okay. And I'd like to remind everyone that if you do have questions for Gary, please submit them via the chat or to me directly. I'd be happy to pass them along to him as soon as I ask him a couple more questions here. So Gary, in terms of, there's been a lot of stories in the press over the past several months about some of the potential dangers and pitfalls that certain banks and other money centers are talking about in the commercial real estate space. How do you see that potentially impacting your current portfolio and or your opportunity set going forward?
Yeah, I would say first and foremost, I actually agree with some of the negativity when it comes to banks and lending and rates and what it does to your cost of capital. I actually think that's a lot of those things are really true. We've been pretty spoiled the last decade. We've had low cap rates, low interest rates. That's a great recipe for good real estate. As cap rates start to move up, your cost of capital starts to move up, things get a little more difficult. The way we've always thought about our debt is, and our portfolios do have leverage. Okay, we target 60% loan to cost in our portfolio, which basically means that we buy an asset for $1 million, we're going to put up $400,000 of equity, we're going to borrow $600,000. We want our debt to be a non-factor, meaning like we just want it to be an extension of our capital, but not something that's going to really move or give you any worry. How we do that is it's primarily bank balance sheet, flexible capital, all fixed rate. And our partners there are the biggest, strongest banks anywhere in the world. So we work with Wells Fargo. It's our biggest partner, has been for a number of years. B of A, JP Morgan. For our assets in Canada, it's Bank of Montreal, right? So that's where the vast majority of our debt's coming from. It's off their balance sheet for the most part. We also want to make sure that it's fixed, and it's fixed for long duration. I think one of the pitfalls that you may see in commercial real estate lending in the near future is debt that was acquired at very cheap capital some years ago that is going to be turning over in the short term at much higher rates.
Yes.
And that affects your income very dramatically. For us having fixed debt, I don't have that worry. And the fact that it has duration on it, things aren't going to turn over that quickly, right? And then on top of that, the fact that our tenants are primarily investment grade, that makes banks extremely comfortable lending to us. And we tend to get our lending not out of the commercial real estate part of the bank, out of the corporate lending part of the bank because they underwrite our tenant, not the hard asset. So things tend to go south on banks, not that I expect them to at the banks we work with, but if they were, they're probably going to go south quicker in the commercial real estate lending than it would in the corporate lending.
Do you work with any of the more regional banks in the United States?
We do work with regional banks on what I'll call a regional basis, right? So to give you an example, if we're gonna do a transaction on a big distribution center that is in North Texas, Southern Oklahoma, there's a good chance we reach out to Texas Capital Bank or Bank of Oklahoma. You know, it's a hometown, facility. They tend to like that. And we do that again when sometimes the big banks, they get conservative pretty quickly, and they may really kind of pump the brakes. You want to have a long tail of regional banks you can then go to get the debt you need for that deal, particularly if you're doing a deal at great terms, right? So we have our, call it 5 to 6 main partners, but then we have a long tail of regional banks, call it 25, 30, that we can reach out to at any point in time. And we try to maintain relationships on both sides.
Okay. All right. So Gary, I think I'm going to start heading to some of the questions we have because we have a bunch of questions come in. So one question that comes in and says, is the income generated tax efficiently?
Yes, great question. I mean, that's one of the beautiful things about investing in a REIT, as you have some tax efficiency. So without being an accountant, and I have to give you the disclaimer, I'm sorry for this, Ahmed, but consult your tax attorney.
For sure.
Generally speaking, what we've seen historically and what you can come to expect is about 90% of your distribution. So that 7% that we send every single month, about 90% of that will be categorized as return of income, which means you can defer the taxes, we can depreciate the asset down.
Right.
So it becomes highly, highly tax efficient of your current income. And then of course, when we sell those assets later, we're probably going to 1031 them back into another asset. But if we were to give you a distribution, as long as we held the asset for a year, long-term cap later. So for your taxable investors, highly tax efficient current income.
Yeah. And I don't have to remind everyone that, part of the appeal of real estate, especially for US based investors, is the tax treatment. I mean, it's
right.
Especially the depreciation you get is second to none. Another question here, ticket minimums and who are your main competitors?
Yeah, ticket minimum, and I hope I get this right. So my team will back me on this, but I think it's 25,000. I'm pretty sure about that. Haven't seen a contract, but I'm fairly certain, depending on how you come in, 25,000. From a competitive perspective, this is going to sound strange, but follow me on it. It's actually typically not another real estate manager because we're providing capital to companies. That's really what we're doing. Our main competitors are the company's other options, right? So can they borrow cheap, right? That's a competitor of ours. Do they have a lot of cash on the balance sheet they can use rather than our capital? That's a competitor. Their credit is typically good because our tenants are mostly investment grade. It means they can issue public debt. That's a competitor, right? So typically it's not, when we're talking to a CFO or a treasurer about doing a sell leaseback, it's typically not us and some other manager in the room. It's us trying to convince that CFO or treasurer that our capital is more efficient than the other assets they have. Now, that being said, I'll give you a couple other names that are in the space. You have your traditional net lease managers, many that we have a ton of respect for that have been around for a while. Managers like Angelo Gordon, WP Carey, LCN, Elmtree. Those are the traditional sort of old school net lease managers. But you also have now the private equity firms who have either built net lease businesses, they bought net lease businesses, or they invest in some net lease, maybe in another product of theirs like credit. So you've got Ares is in the space, Blackstone, KKR, Carlyle, Apollo, Fortress does some of these deals. So you got a number of people that
I'm not sure we lost Gary.
I'm still here.
Okay, you're still there? Okay. So did I freeze or did you freeze? Because from my perspective, you froze.
I think you froze, but I could be wrong about that.
Okay, yeah, that's fine. So I missed the second part of your answer. So I don't know, were you done answering it? Because that was a specific question that came from the field. And if you did, I'll move on.
Yeah, all finished. Yep.
Okay, great. Yeah, so apparently like I froze. In terms of, I have a question here that says how have increased rates affected your business? And I definitely want to get into that, but I also want to sort of address the second part of this, because if I, as a CIO, for example, I'd be I'd be modeling your asset as a sort of hybrid asset where it's sort of somewhere between private credit, like you well said yourself, you kind of alluded to that yourself, because at the end of the day, the real risk is the underlying tenant, the credit risk of the
That's
of
right.
the tenant, and you have the backing of the real estate. So you're sort of in that hybrid space. What I've been noticing in talking to managers in the space recently is that there's sort of conflicting forces right now, in that on the one hand, they're seeing enhanced opportunities because a lot of the, let's say, regional banks are pulling back. They're more conservative. Their funding costs are going up. Their cost of capital has gone up. So they are less active in the lending spaces. So you have more access to deals. But at the same time, on the other side of the equation, so to speak, we've had a ton of money go into private credit. And we've had a ton of money go into private markets in general. So you're also competing with more pools of capital in terms of the deals that you want to source. So how do you see your, let's say, your opportunity set? Is it more challenging? Is it better? Is it worse? How would you characterize it right now?
So you said a couple things in there that I think are absolutely accurate, and I want to unpack them. So I think you made some really valid points there. So allow me to go back. So the first thing is, you mentioned you see us as a hybrid. I couldn't agree with you more on this one. And to make me and you right on this one, if you looked at our biggest institutional investors, I'm actually headed back to Asia on Saturday to see a bunch of our sovereign wealth investors and big Asian insurance companies. The vast majority of them actually put us in their credit allocation, not the real estate allocation, right? And they do that because, again, we're not correlated to traditional real estate. It's not about the hard asset. It's much more about buying that income stream from a high quality tenant. That's really a credit play, right? I mean, that's really what it's about. So I couldn't agree with you more there. We are certainly a hybrid. We tend to get allocated in a fixed income alternative, private credit bucket. At this point, like I said, less than half of our investors have us in a true real estate bucket. So I want to make that point because I think you're exactly right. The others you mentioned, this actually isn't seen sometimes, where people associate higher interest rates as a full stop negative for real estate. And I would say, if you're doing traditional real estate, yeah, it's not great. I mean, your cost of capital is higher. For us, because we do serve as an alternative source of capital for these companies, higher interest rates actually helps us, right? Because that means for the companies that we're buying real estate from, their cost of capital is higher, right? Which makes it less accretive for them to take on more debt, right? But if they own real estate, which is a non-earning asset sitting on their balance sheet, and we can make it earning for them, well, when rates are high, that tends to be a better capital allocation solution. So this actually drives more opportunity for us. So I'll tell you, no questions asked, this is the biggest pipeline we've had in the history of Oak Street, 13 years. Biggest pipeline right now, okay? We have a near-term pipeline of $45 billion worth of transactions. We have $2.5 billion worth of transactions under LOI, okay? Nobody's buying real estate today, right? I mean, volumes are like off a cliff, right? And we're out there, literally just doing deal after deal. This is not unusual, and it shouldn't be a surprise to you. We tend to be counter-cyclical, okay? Yeah. Our biggest year prior to this, 2020, COVID year, we bought $4 billion worth of real estate in 5 months, right? Again, because companies needed liquidity, right? They wanted to lower their debt profile. And a fast way to do that is monetizing your real estate. So you take the good with the bad, right? Our cost of capital is now up as well, right? We were financing deals at 3% 2 years ago. Today, it's between a 5 and a 6. But we're also doing deals at much higher cap rates because those companies need our capital. So I like that you gave both sides of the equation, because we tend to not get credit for the good side. It's sort of seen as an all-time negative. And I'm saying, I don't like high interest rates either. However, it does drive a lot of business our way.
Understood. So another question here that's come in, it says, besides the 7% distribution, does the NAV fluctuate?
The NAV will fluctuate, yes. So there's two numbers I give in terms of expectation of performance. So 7% annualized distribution. Again, you'll get that every single month, and we've never in the history of Oak Street missed a monthly payment. June is month 161. And we send an email to the firm every month that we pay distributions. That's our first job. Total return expectation should be a net 10 IRR, okay? And why it's a net 10? Net 10 comes from our underwriting is extremely conservative. It's just income coming from the asset, because it's contractual for 15 years, We put in rent escalations into all of our leases, say 2%, and that's a 2% net number because we're not exposed to any expenses, right? So it goes right to our bottom line.
Right.
So it's your income plus your rent growth plus our leverage. If you just do the math on that and put it into a model, this is a math equation. It gets you to a net 10 IRR. As long as the tenant's in the building paying rent, which is why credit's so important, you'll hit that number. Now your NAV will fluctuate month to month. There's no doubt.
And that's mark to market on the buildings or on the how on the leases. How do you establish that NAV?
Those three major inputs to your NAV. I mean, there's multiple inputs, but there's three that really move it. It's income coming from the asset. Again, we're in triple net, so that should be a nice anchor to you. It's a cost of your debt, and the short answer is the way you think about that is how much is the debt you have on the portfolio cost you today? Sorry, on the portfolio versus what it would cost you to put it on today. Again, if our debt is bank balance sheet, non-recourse fixed debt, that should also be an anchor. The one that moves the most is the one that most people know. That's just how are those assets traded in the market. So they'll look at similar transactions. They'll talk to the broker market and say, well, what do you think a 7-Eleven goes for in this market? And, broker says, I don't know, the 6 cat. That also goes into your NAV. So when we mark those assets each month, those are the three main inputs. Now, the NAV hasn't moved a whole lot since we launched the fund. So we launched the fund back in August, right? So we've had about 8 months of marks. We launched at $10, right? That was the price at that time. It's gone up as high as 10.32, down as low as, I think today we're like at 10.13. But the interesting thing about that, the value of the real estate hasn't moved. If you looked at the marks on our real estate over that time, it's been flat. The movement has been either us paying our distribution or we utilize swaps to fix our debt. Don't worry about that. It's an instrument just to fix your debt. When capital markets are volatile, it moves. But again, net lease has been the most stable asset class within real estate. So what I'll tell you is I'm never going to say that the NAV won't be volatile, but it should be less volatile than everything else within real estate because you have that stable income stream, stable rent escalation.
And what's typical, let's say, default rate on these leases for you guys historically?
This is my favorite question because it's the easiest one to answer. The answer is 0. We've never had a default in our history ever. We've never had a vacant property ever. We've never had a single missed rental payment. I'm knocking on wood here. Never had a single missed rental payment. And that includes the COVID months. Every single tenant paid every single month on time.
That's throughout the history of the firm, or
across all products.
This one specifically? Oh, okay.
Across all products. That's right.
Products. Okay. Do you stress test like a certain default rate that you're like, well, any insights there?
We do. So we stress test a default rate. We also stress test what we call no residual value on the real estate. Like say the real estate value goes to 0. Okay. And in that situation, as long as the tenant's in the building paying rent, we would still deliver somewhere around a net 6 IRR and a 1.7 net equity multiple, even if at the end of 15 years, the hard asset wasn't worth anything, worth nothing. And the reason why you could do that is because you had a tenant paying you rent the whole time, which means you had cash flow, you had income.
Right.
That's why we start with the credit, right? That's why credit's the most important thing, right? And we stress tested a number of scenarios on default. Again, without going into detail, what I can tell you is we'd have to be north of 25% default rate for you to be materially impacted in any way. And by the way, you'd still make money, right? You wouldn't be negative. You'd still make money. But we'd be well below our target. But my point of view is if 25% of our portfolio of IG companies default, we have way bigger problems in the world. You are not going to be thinking about my fund. We're going to be thinking about something apocalyptic.
Yeah, I mean, if that's what you're, because I mean, in the worst recessions, high yield will default at 8-9% maybe.
Exactly, maybe 10, right?
Maybe 10, right? So, and that's high yield credit. So, another question here: Do you have gates currently in place?
We do not. So we have a 1-year lock. So we are monthly subscription, quarterly redemptions with a 1-year soft lock. However, we will cap our redemptions at 5% per quarter, which is pretty standard for an open-end real estate fund like this. Now, because we're in a 1-year soft lock and we're still within our first year, we don't really have redemption. So I want to be honest and fair about that too. But those are our terms. Right. Monthly in, quarterly out, subject to a 5% redemption per quarter, and we do have a 1-year soft lock.
Okay, excellent. Well, Gary, unfortunately, we've run out of time here, but thank you so much for joining us this late afternoon here. And hopefully, I think many people in the network were able to get a good sense of the product, its where it lies in the capital structure, or at least within their potential asset allocation buckets. And really appreciate your time.
Pleasure was mine. Thanks so much, and we appreciate you considering Blue Owl. We'd love to work for you.
Okay, thank you so much.
Thank you.
Have a great evening, everyone.
You as well.
Take care. Bye-bye.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.